If you had to choose only one, guaranteed cash flow or big upside with no guarantees and no cash flow, what would you pick? This is the single most important question that you need to ask your potential investment partners when you are going through what I call the discovery process. And in watching this video, you're going to learn how to classify these investors and how to strategically use both to scale and be able to raise millions of dollars in capital to scale your portfolio to the moon in the future. But before I get into all that, I want to frame this in the context of the mistakes that I've made early on in the process. See, my original model back in the day when I was buying $1 to $2 million deals was I raised the capital from private investors and I borrowed it from them essentially and just paid them a fixed stream of income. And then I would bring in bank debt to fill the rest of the capital stack. Okay. So when I was going through this discovery process of talking to potential investment partners, my whole approach was if you wanted equity, for instance, you wanted the big upside with no cash flow, no guarantees, then I essentially deleted you out of my sphere of influence. I was like, I don't need you right now. I'm not going to need you ever. And I lost a lot of time on keeping those people nurtured for when I was going to need them in the future when I was doing $5, $10, $15 million deals, for instance. And this is the same exact thing that happens to my clients as well. So the psychology behind the question, right, is this is like a compass, right? Cash flow or equity. This is how I classify the two investors. And it's a spectrum, but they're generally anchored to one or the other. For instance, somebody that's in their early 30s, their objective will be growth and long-term appreciation. They don't necessarily care about cash flow. This is the reason why people primarily invest in the S&P 500 index funds, because they don't pay any dividends really. They pay maybe like a 1% dividend. It's nothing. And people aren't really anchoring this as an actual objective. They want long-term capital growth and are willing to take on the volatility and risk associated with that because they have time to earn back. People that might be in their late 50s or 60s, they've already done this phase of accumulation in their investing career. All right. So their objective at this point in time is going to be capital preservation. They don't want to lose money because they don't have the time left in their life to actually earn back money that they could potentially lose in more risky investments that are associated with equity, for instance. And also they want income, for instance. They want the capital they have to produce cash flow to support their living expenses. All right. These two buckets, cash flow versus equity. Cash flow investors, they want predictable returns, safety, and income. Equity investors are willing to wait for a payday, but prefer back-end upside and don't really need the cash flow right now from day one. And this is why you want to prioritize cash flow investors early on. Number one, when you're doing $1 to $2 million deals and you're flying below the radar with working with banks that are looking more on the actual property and the cash flow of that property rather than you and scrutinizing your own personal balance sheet. And this will allow you to keep 100% of the equity in the deals that you do, maximizing their financial impact. I've covered this in previous videos I've done. And then also by avoiding giving up equity significantly reduces the amount of complexities and paperwork that you have going on as you're trying to scale. Because remember, when you bring on an equity partner and you form an LLC with multiple members, that entity is going to have a yearly tax return with its resulting K-1s that it needs to be distributed to the actual partners itself. When you are borrowing money from private investors or passive investors, then you only give them a 1099-INT interest statement at the beginning of each year. It's easy to calculate how much interest you've paid them. And then this allows you under this framework to stay liquid by keeping the cash and liquidity on your balance sheet and keep the banks happy and approving your loans as you scale in this $1 to $2 million deal paradigm. Next, I'm going to cover on how to run the discovery process with these potential investment partners. I've covered in previous videos on my framework on how I prefer to educate my sphere. Okay. I don't necessarily want to go to my sphere and say, hey, listen, I'm looking to solidify relationships with potential investment partners for deals you want to raise capital for. I prefer to take the indirect approach because most people are envious of your position as being a real estate investor. I've said that you're in the 6% club, right? 94% of Americans do not own income property. So therefore you are a freak. People are genuinely interested and curious about what you do. And the reason why they don't exercise on that desire to become a real estate investor is because of the 4 T's, right? The tenants, trash, toilets, and most importantly, the time associated with trying to learn a new business. So I like to educate them on, hey, I'm a real estate investor. Do you want to own investment property someday? I want to genuinely take an interest in helping you learn the ropes, so to speak, on how to position yourself to take down deals on your own. Most people are not going to actually take action on that. But what you want to do is you want to be a friendly go-to person as the go-to expert in their sphere of influence on this. So generally, we're going to talk about finances, right? I'm interested in investing in real estate, but I don't have the liquid capital, for instance. So then I educate them on how they can actually find hidden sources of capital. I did this on the actual, I think it's the 5 sources of capital in one of my YouTube videos that I'll actually have at the end, a link to that, all right? So this is the question I ask. If you could only choose one, and you could only choose one, right? Guaranteed cash flow or big upside, what would you choose? All right, so first, if they say, yeah, I just want cash flow, I want my money to work harder for me, then I ask them, what types of returns are you targeting? What would make you happy? So I can see if that's actually in alignment with your market or your target and that sort of thing. And just asking these questions about what their objectives would be from a cash flow perspective, what type of term or time horizon they'd want to have their money deployed out in the street. Is it 1 year? Is it 6 months? Is it 3 months? Is it 5 years? Is it 10 years? Are they completely ambivalent about the term? Those are good people to know too. And something I almost forgot, there's a bonus question is also for those cash flow investors is asking them this. Would you prefer to get monthly payments or would you prefer to defer the monthly payments and let your money accrue interest? This is a very important question because some investors actually want to have their interest compounded, don't necessarily need those cash flow distributions right now. But anyways, if they say equity and they're like, yeah, I don't really need the cash flow. I'm just looking to have my money work harder for me, but I want to have long-term equity appreciation, then that triggers what this conversation is going to look like. All right. So the first thing I ask is when we are putting together deals, for instance, because we raise capital from private investors, if you have an equity position in anything, whether it's in one of our deals or your own, the bank is going to require you to be a personal guarantor, even if you own that property under a limited liability company. Are you comfortable with signing on a loan as a guarantor for potentially hundreds of thousands of dollars worth of debt? And then if they say no, then that goes in a different direction, right? Then educating them on, okay, that's great, but there's also a ability to be added to an ownership group if you own less than 19% ownership interest in the property, where it wouldn't trigger you being a guarantor on the debt. The follow-up question to that is, all right, the banks typically will look at your net worth and they'll typically look at your net worth. And most banks, as you get above a certain level, are going to have a hard and fast requirement that your net worth is equivalent to whatever the credit request loan amount is. So if you're buying a $1.5 million property, you have $1 million loan on the property, you need to have a net worth equivalent to $1 million to actually get approved for that loan. All right. Some people don't know how to calculate their net worth. So the question I ask is, can you walk me through your balance sheet? What type of assets do you own in terms of like retirement accounts, other real estate assets, whatever it may be? Brokerage accounts, do you invest in the stock market? Do you have any annuities? And then what types of debt do you have, right? You probably have your primary residence. Like what other debt do you have? So you can get a idea of how wealthy this person is. If they don't have any net worth then at all, then this may be a different conversation. But if they do have, after running this, I have about a $500,000 net worth or so, then that may not be like the type of like whale you're going to need in the future. They can still be an equity partner in the future. I'm going to go into further on in this video as to how you can actually leverage them. But really in this process, as you're filling out your spreadsheet of these contacts, for instance, and the different things that make them tick is to, number one, classify them as cash flow or equity investors. And then of those equity investors, are they going to be a passive equity investor or one of those whales that has a monster balance sheet that can actually help you get approved for 10, 15, $20 million deals when you're doing those in the future, if that's an ambition of yours, which I'm always an advocate for positioning yourself to that, even if it's not something you want to do right now. So for instance, where do you meet these people that have, let's say, a 5, 10, $15 million balance sheet, for instance? And one of the things is that raising cash from cash flow investors is going to be very difficult when you're talking to other real estate investors. Most other real estate investors want to be actively involved in owning the upside with deals that they do. So generally speaking, you're not going to meet cash flow investors at real estate meetups, but still go to real estate meetups, network with other real estate investors, especially successful ones, because generally speaking, most of the millionaires in this country are real estate investors, right? There's a statistic or something like that. I don't even know if it's correct, but 90% of millionaires have made their fortunes in real estate. So these are the types of people that you can form relationships with where you can actually collaborate with them in the future and bring them on as an equity partner for their actual balance sheet, right? So this is actually where I've been able to, like the last deal that we did, we brought on a real estate investor that was very seasoned, multi-generational real estate development company that has a net worth of $50 million, okay? If I would have been going under the old paradigm of just seeking cash flow investors, which this investor doesn't care about the cash flow, he just cares about long-term wealth and creating that intergenerational wealth transfer, then I would have written this person off and I would have never put in the work to build in that relationship. And actually, I didn't. My partner, David, was the one who owned that relationship because he had been going to the gym with him for several years, and this relationship incubated from there. So that being said, I want to introduce you to the concept of no cash guarantors. One of the things that some of these capital stacks we put together for our deals, and our clients do this as well, is that you may have a high net worth individual that might be worth $10, $20 million. And the one thing is that I don't necessarily even need to use their cash. I might need to just use their balance sheet, right? So this is how this conversation goes. So if you talk to somebody that I have a company that has a printing company that we do about $10 million a year in annual revenues and blah, 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 blah. One really interesting angle to bring them in potentially in the future is asking this question. This only works for people that are high net worth individuals. Would you be interested in a deal where you bring no cash but still own ownership just by signing on the debt alongside us? And this is what we do, is we raise the capital elsewhere. So we raise the capital from our cash flow investors, our private investors that don't want to have any additional liability besides losing their own cash. For instance, they don't want to be liable for the millions of dollars worth of debt on these properties we put on it. And what they do is that these investors bring their balance sheet to the equation. They become part of the ownership group, and then we give them 25% of the ownership in the LLC for these deals, for putting no cash in and just on signing on the debt. So I always ask them, I was like, does this sound interesting to you? And some of them will say yes. Generally speaking, real estate investors, they said, yeah, absolutely, would love to partner in a deal. When you're doing bigger deals make things interesting for everyone. It doesn't become chump change for people. When you're doing a $10 to $15 million deal, this can be 25% of that is a significant amount of wealth just for signing on the debt with a pen. So case study, a few years ago, I had to raise $400,000 for a deal we were doing. And the way I put together that $400,000 in cash was I had 50%, or about half of the investors were private lenders that we paid 10% interest to. And then we had 50% of that cash came from equity partners that had no cash flow. Okay. We had no preferred return, none of that stuff. It was basically when the property was stabilized, we vote on it as an ownership group as to how to start distributing cash out of the operating account to those partners that are in on the deal. All right. So this is a perfect scenario, for instance, for lease up and renovation deals where cash flow needs to be delayed, because 10% interest on $200,000, for instance, in this deal, it's a lot easier to float that than it being all debt. So this is the reason why you want to start building those relationships with people and identifying what makes them tick and where they are on the spectrum of either cash flow or equity. And then as long as you have an ironclad business plan and you execute it well, and also you have enough equity spread on the back end, which is what we make sure of whenever our clients do deals, when we refinance this property, we're gonna be able to get everybody paid back their cash. Then you have something that is actually very repeatable and scalable from there. So here's the major lesson from this training is never close the door on a potential investor. Just because they're not right for today's deal doesn't mean they won't be the key to tomorrow's. This is a long run game for you. It's not, you're looking to get rich in a year or two. This is generally, most of my clients want to be able to scale their portfolio and replace their income less than 2 years, and then create the absolute lifestyle of their dreams there and after, which requires bigger and bigger deals as a result of it. And the main problem is that their balance sheet just doesn't keep up with it. If they want to keep doing $1 to $2 million deals like block and tackle over and over again while raising the capital from private lenders, then they can do that. But if you want to get into being less busy and doing even more larger deals that are more interesting from a return standpoint, then you have to be flexible. And the time to start those relationships is now. So here's the key to winning the long game. So keep everyone in your investor ecosystem. Those people that are equity investors, make sure to keep them updated on the deals that you do, even if you're not using them during the first couple of years. It's just like when you close in a deal, when you sign a major lease with a potential commercial tenant, when you refinance the property, anything like that might be a deal update, make sure to keep these investors, everybody that's in your sphere, aware and top of mind, leading you as the subject matter expert and the go-to person. And then what I love to do is just meeting with all these people once or twice a year, just to keep that relationship nurtured. Okay. This could be for coffee, lunch, dinner, whatever. This could even just be being present. All right. So you don't need to take every individual person out there, but if you're going to a real estate investors meetup every single month, my objective is one new friend when I go to a real estate meetup, and then also talking to friends that I've already built their relationship with and scheduling follow-ups from there. Hey, it's been a while since we got coffee. Let's go out. And then this long game approach is going to help you cobble together the capital creatively when the right opportunity does show up, because there's going to be deals that will come your way that do not fit the mold, but they might be amazing, smoking hot opportunities. So you want to make sure that you actually have the infrastructure built in the beginning so that you can have multiple entrance strategies into deals in the future. So if you got value out of this, please drop a comment below. Let me know what you learned. Let me know what you want me to cover in the future. I am an open book, and my objective with putting this content out there is to help all of you graduate from doing residential deals to doing larger commercial real estate deals. And if you want to have a one-on-one approach, I have a unique opportunity. I am launching our next cohort with the Go Bigger Sooner mentorship and mastermind program, where I've helped over 35 investors over the past few years graduate from doing small deals that pay them chump change to being able to celebrate early retirement. All right. My client, Brian, I have another case study that I'm going to drop as a follow-up video. The deal that I helped him with, it was a 56 unit deal, added $1.8 million to his net worth and about $200,000 in cash flow. And he is actually retiring early from his corporate job this summer. And I'm actually helping plan that retirement party. I'm going to be the corporate beer sponsor for that. So if you're interested in how I can help you step by step, I have a very individualized approach. I don't have some sort of cookie cutter program where you would just watch a bunch of videos. I become your on-demand advisor, a member of your board of directors, so to speak, helping you game plan from day one. And also so that we're helping you game plan from day one and helping you execute that game plan every step of the way as this business throws you curveball after curveball through the process. So make sure there's a link down below in the description to book in a call. It's a 1-hour consultation. 80% of the people, this is not the right program for them, but I'm willing to give you an hour of my life to at least see where you're at, see where your goals are, where you're struggling most right now. So at least offer you some insight, even if you do not become a client. It's my honor to be able to help you as well. So thanks for tuning in. We'll see you next time.